How's it going? Gonna keep this one a little short and sweet for a few reasons. One, again, most people that have been following us know what we do already, but this video is maybe as a refresher, kind of the tools and software we're using for our investment strategy on swing spread trades, which is basically commodity spread trading. Kind of give you a quick knowledge of what it is, what it really is, what it means, how simple it is to really grasp the concept, and then explain how we utilize it simply in our swing trades. And so getting started off here quickly. And so today what I'll do is a lot of the jargon or kind of a little more technical nuance stuff that's not as important. I'll mention them, but not talk about them because they're not that important, especially if you're following our trades or following one of our, a newsletter. As long as you know what futures and commodity markets are, which most of you do, then it's easy to understand what a spread is, which is, you could call it a pair trade. It's definitely not an arbitrage trade. A lot of people I've been hearing say that arbitraging is almost a risk-off trade that has nothing to do with spreads. You can call spread a cousin. It's not. Spread trading is still high risk, so be sure you read all your CFTC disclosures. It's not as high risk as outright trading because we're spreading, like the word says, the risk between two different contracts by buying and selling a related or highly correlated contract. Just like as it is. In return, we end up getting a major discount from the exchanges to do that. So therefore, when something is less risk, is your reward just as big? No. We're going to discuss that. We're looking to be able to take advantage of all the different commodities that are out there to trade, if feasible, based on margin, based on risk, based on that account size, and take advantage of swing trading with less money, less margin, and pretty good cash on cash return. So essentially all this is what a spread is. And it's a relative trading style. It's done to take advantage of the difference of the price of the relationship of the two changing assets. So it usually comes off the most simplest thing to do is called a calendar spread. And we'll take crude oil here, for example. If you take this is the August 23 NYMEX exchange crude oil on a daily chart, line chart. Obviously, you see the whole downtrend, and how you would trade these outrights is, hey, if your bias is short, you're obviously trading into these pullbacks, and you're trading it all the way down. That's what you would do, right? Or you'd buy, long, or you'd go short. And it's similar in spreads, but there's nuances in where it is directional, but it's the directional difference between two of the crude oil spread contracts. In this case here, August, and I purposely picked August 2024. This is 1 year out wide of the spread, and the difference of the two in price off of that term structure. Because look, traditionally, most deliverable products, the way that they trade in a normal market, which is called contango, and this is one of the things that I didn't want to get too much into today. Don't want to confuse people or discourage anybody. I want basic traders to be able to come here and trade professional strategies. But the difference between normally the longer term structures are more expensive because of cost of storage, insurance, and things like this, carry rates and stuff. And therefore, usually in a perfect world, when the supply doesn't come up to the front because of a big natural, maybe a big refinery blew up and so the shortage of crude, this is kind of what sways the supply demanding of that term structure. So generally, our front month, which is always going to be the one that we're currently trading, that day traders are trading, that front month it's called a front month, and all the other months are the further out months, back months and things like that. So this is just simply a line chart of two separate calendars of the crude oil. And so let's see here. I'm going to talk about the different type of spreads. In a little bit too, I'm going to show you the platform that I use called Trade Pro Trinity. That's a dealer, broker that I know here in Austin that basically understands spreads and offers a wide array of different platforms. I use that particular platform to put on and manage spread trades. And it's a very popular platform itself is made by Open Outcry. So it's some very easy to use, and I like easy to use tools when I'm managing money. other thing before I get into showing charts is, let me back up and explain to you guys one of the other goals in relative trading that we're trying to do, and I hope this is explained good enough, is, let's see if I can get, if you're looking at, like, let's say trading any market outright, okay, ES or crude oil, you are always trading against the dollar synthetically, whether you know it or not, because that's the dollar dollar is the currency being used to exchange that or trade that market. And so you're also having dollar risk, dollar volatility risk in that asset class. Unknowingly, most people don't know that. It's only when they trade forex pairs that they'll say, hey, I'm trading the dollar versus the JPY, Japanese yen in this example. But when you're trading an outright contract, there's dollar in there, volatility risk of the dollar. And one of the things by doing relative trading, if we use the correct, obviously ratios and stuff we'll get into, you're extracting that. So if I can get, let's see, a highlighter here. Bear with me. Change the color of this highlighter. Yeah, this might be messy, but I want to do something like, let's say, we're going to trade the ES contract, and right now we're in September, and that's 3 for 2023. As I said, when you're trading it, you're trading the ratio, you're also trading it as a dollar factor in there. But if I'm trading it against another month, like ES December contract, so I'm trading the spread between these two, the same thing as a dollar. Now, what do we learn in elementary school? These two cancel each other out, right? Because they're the same. What these two aren't. I mean, they're the same ES product, right? But it's a different month, right? So that what we're doing is we're neutralizing and getting that dollar out of there. So that also reduces the risk, and also because they're the same products in this case, which is like a calendar spread, and we're going to talk about the different types. It also becomes very less margin necessary to trade. Okay, so we're going to talk about the intramarket spread, and these are also known as calendars. So it's just basically, in this example, this is a copper, high grade copper, and we're looking at the September month versus December. So HGU3 minus HGZ3. If your intention is for, and we'll chart this in a second here, for this spread to go down, like in other words, you're saying the front month or price is basically going to go down, then you would sell the front month and buy that back month, and so therefore that's called a bear spread. Additionally, if you did it flip the other way, then that's just simply a bull spread. Okay, and this is a basic intramarket calendar spread. You can put a lot of these on in broker platforms that understand exchange recognized spreads. That's what these generally are. The real simple ones, and I believe that most people should be getting started and running their business on these. When we were running our spread business, we had a lot of guys that were very technical started coming in, guys that were doing quantitative spreads. And it actually even threw us off because it got too intense. And we'll talk about those two later. There's multi-leg spreads out there, flies and this and that. And, they're really at institutional level. I don't believe that retail level we should be too focused on that. You're talking, and I'll show you some examples like of a cattle crush. So let's go ahead and move forward. So the difference of how they move in span margin. I want to pull up some of our partner tabs here and some of the tool tabs that we use. So we got bar chart in front of us, and I'm looking at the whole, and we talked about term structure earlier, right? You look at, this is the front month here, July. Let me filter by volume. As you see here in copper, September, it's running the most volume, and then as you get into the further months, it becomes more expensive and more expensive, and more expensive, and then the following year, that's when they expect it to drop again or whatever through seasonality, and or they're not even trading it. I can show this better on a more liquid product like crude oil or something like that. In fact, let's just go ahead and do that. so you guys can understand kind of that term structure. What I'm talking about. Here is the price, and here is all the months by volume. And as you see here, crude oil gets more or less, more expensive in latter months. Kind of mixed, but that's the gist of things. Sometimes the front month, depending on demand, we'll get the market a little bit backwardated. And a better way to look at that is our partner site here, spreadcharts.com. And this is an example here of the term structure of copper, right? So these are all the different months, the front month and all the back months, and this is what's called contango term structure, right? So that's just kind of little thing there. But I want to talk about the value of difference of, like, obviously of the outright and why the spreads and how they can be cheaper. If we go back to the high grade copper and we're looking at the outright, and then we pull up a spread, well, let's pull up the outright first and say, okay, here's a mirror image of our macro charts, on high grade copper on TradingView. And I also use TAS Market Profile, so we'll talk about my investment strategy later. But if we just did the same thing here, for example, and pull up the interactive chart on the outright of September copper, we rallied a little bit last week up to these highs and then sold back off Friday and today. Okay, I think something with dollar index too. We talk about correlated, uncorrelated markets. But if we look at this ATR, a 20-day moving ATR is a 0.0781, meaning that every 20 days, if you are long or short in one contract in high-grade copper, basically, if you take the point value, multiply that ATR, so go to contract specs and get the point value, and the point value is 25,000 points, and we're talking about point 0.0781 can move every 20 days. So just calculate 0.0781 times 25,000. So that's, you can make or lose within, in the last 20 days on a daily basis, $2,000. But when we take a spread, now again, not all spreads are made equal. So I'm not saying or recommending that this particular metal spread is the way to do it. When I first started, I traded almost every kind of spread, and I had people like, managed brokers that would work with me and tell me, hey man, you might not want to do every spread that you see, especially some of these metal spreads, right? But same technical advantage here, same technical play around the 22nd of June or something, or whatever it was. Yeah, June. If we take this short here, just alone, if I could use the calculator, you can see that we're at 0.0042. That's a 20-day ATR. That meaning that in the next, in any given day, for 2 times 25,000 a point, I can make or lose $100 instead of $2,000. So you can see here where this is 10% of the outright move, right? So then therefore, because our risk is smaller and it's a calendar spread, we're just trading at two different relative prices of this copper, then the market is going to give us, the exchange is going to give us a huge discount of up to 90%. Okay, now this is how these things work. So it makes clear sense, right? Because I'm not participating in 90% of this profit or loss, only 10, and therefore, and I'll show you on Trade Pro Opportunity later on how I'm getting that margin discount. So that's one example there of margin. Of the risk change, the volatility change. Therefore, also your margins will be much more affordable, and then you can participate in these swing trades with a smaller portfolio size, still using percentage risk management or swing high lows. Whatever your rule is, if that fits the percentage, that should be ideally the optimum thing you should be doing. Okay, so that way, and now explain the intermarket spread. Okay, now these are just a pair trade that's basically two highly correlated markets, but different markets, but in the same assets or bucket of energies versus a different kind of energy, different kind of meat, different kind of but in the same months. Okay, so in this case here, if you look at the orange line, since the beginning of the year, obviously tech has taken off again on ES, so ES is in blue. These are September's, so NQU3 minus ESU3, and pretty much if you swing trade, you know the correct ratios. Now, when we talk about intermarket spreads, there's ratios that are involved that you have to have, because the fact that it's not the same product, that's one another reason why I say keep it simple, just do calendars. In here, we have to weigh the correct weighting on a notional value. We're going to talk about that here in a second. So, market spreads. The question we always get is if like you could just have a depth of market that's already made for it, one order in, one order out. Yeah, you can on the calendar ones. On some more professional platforms, you can create a synthetic depth of market, a synthetic dome that will allow you to put these ratios together with the intermarket ones, because they will be more difficult. And obviously now if it gets a little more advanced here, if you don't have the correct amount of contracts that the exchange is expecting you to have a balanced intermarket spread, then the span margining changes up on you. So you have to make sure you're balanced. And I made a video several weeks ago, and I'll put it at the bottom of this video. That's a free spread margin calculator. And it looks just like this. If I can bring it up here. Let me turn this slideshow off real quick here. End the slideshow and pull up this right here, guys. And this is a spread contract equalizer. So, I'm not going to get too much into it, but if, you do contract 1, ES contract 2, and then the multiplier, which is the point basis, and you can get all this information for free off bar chart. Just get the price of the point, get the price of the current price it's trading at, and those multiplied together is basically what's called notional value. From that notional value, that's how much stock you're trading of that S&P or the NASDAQ, or that's how much cattle you're trading, contract size per contract. And so you can see here how these ratios can change to be balanced. So over time, we are just running quite balanced, and there's not one pushing one the most, right? And then also this way, for example, a lot of people say, oh, by default you do 2 ESs to 1 NQ. Well, I still have $140,000 variance. That's not necessarily always right, because price is always moving around and things like that. If I do 3 of these and 2 of these, yeah, I'm buying 5 contracts in, 5 contracts out, but now I'm more neutralized, you see. So I have a whole video on this one on how I was using it, and you can also use 2 different kind of units, like where 2 different kind of metals are weighted differently, and how to fix that. And then also 2 different products if you were doing an exchange somewhere out in Asia. I don't know why I would be. I don't like to get all technical like that in advance, but you can weigh out the base currency too. But I just use the top here on a single currency contract value equalizer. It's free. The guy sends it to you for free. And so credit to him. I didn't make this. I found this. I was searching and searching for something before I had to go and try to make one myself. And I was able to find that. So I felt pretty good that I was able to find that. And so I just share it with everybody. Why shouldn't I? So one of the questions was, people ask me if you can do this short term. And you know what? I've done it enough times short term where, I've passed these funded trader programs doing spreads intraday. You just, it takes a lot more work, and there's not going to be opportunities every day, but you could. I mean, equities, you can spread on equities intraday. But generally these products are made for, swing trading, short and midterm. Some of these trades can last for weeks, months, or most of the average ones about 20, 30 days. So, and again, it's you put it on and then it's hands off until it's time to bail. And if you're in an exchange recognized spread, then you could place your stops just, and just do your thing and then rinse and repeat. And we'll talk about how I do our investment strategy from that. But, can you day trade them? You could. And we've proved it time and time again on those to show people, hey, we did it all at spreads and funded trader stuff. But it's not the best way to go. I mean, you want to do this right. You want to get to the point where you're managing other people's money, which is one of our goals as of today, where you can then spread this across 20 different commodities and actually manage risk. And it can be very rewarding. So let's talk about the span margining again. I'm going to have to pull up our Trade Pro platform to show you guys how I would do this. So real quickly though, to put on, to view a spread, let me go to my spreads list. I mean, this is all the equities right now on a daily chart, right? If you look at that, NASDAQ, we got the yellow one is Russell, YM, and then that bluish one right there is ES. So these are, equity pool I'm looking at, just, daily strength, weekly strength. Obviously, tech is always usually kicking butt. How would I put that together? That spread on that copper. Let's just go ahead and close these ones out. Real simply, you just take those contract months. HGU 20. In this case, in this platform, you got to do the whole year minus HGZ 2023, and boom, that's it. Price this up at regular pricing, so that's where our price is 0.0200. It's exactly where we are here on our bar chart, 0.02000. Right? So that's it. That's simple as that, guys. Trade these; they trend a lot better for the most part. And again, based on your RR, you can ride these things out for a good amount of time. So let's put this back up here, and that's the way you chart it out, depending on what charts. For me, I like the professional chart. Let's end this back up here, and then pull up our Trade Pro Trinity. This is an account that's just on demo right now here, and so how would I pull up? You can pull up many different ways. You can say, hey, I want to trade a complex. I'm sorry, not a complex, but just a calendar spread. So I go G, high grade copper, and then they would come up FTS. And you'd get used to this after a few times. It's really simple. FTS just stands for the future time spread, and they already have all the exchange recognized ones here. But the thing is I want to go bypass this contract month, and I want to get to, I want September, right? So I go plus U23, and then I want to go against December, Z23, right? So there you go. Boom. There's that. Now, if I want to take a look at that and how it looks and add it to my, before I put in an order, now this is a market order, you can put it as a limit. I'll show you what you can do here. Go to your quotes and add it in there. Now I've added it to my quote board. Did I add it to my quote board? One moment. Boom. Okay, now it's in my quote board. Now I can chart this. And here's the daily chart again. And as you see, the price is at minus 0.0200. Okay, I'm using the TAS market profile here. And that's a subscription service. We'll talk more about it in the next few weeks. It's pretty dynamic. Quite a really nice dynamic volume profile system. Let's dock this back in here. Move this back up. Very nice system, easy to use. And I think I can now right click here where the quotes are, and I can bring up a dome, and now you guys can see it. Now I only have top of book on this platform, and I'll tell you why. I don't need to look at the market depth to trade. this stuff I've already analyzed using software and other outside third-party tools, and now I just know I have a limit order. Let's say I want to get in, and that's when then I can come in here and say, okay, well, I want to get a limit, and this is the limit price I want. I want to buy this now, so I'd buy this month and I'd sell. I'd buy September here, and so I'm buying the spread, right? Real simple, and then you put in the order, and you're done. And you get filled, it'll be over here in your filled orders, and etc. And it's like you're trading an outright. So once you understand the concept, it's very fairly simple to put these together, put these on. You got to have the right broker that understands you. And let's talk about the margining. Margin calculator. I'm going to pull up the same thing. So let's say I wanted to trade GHG high grade copper September, right? And I want to buy this, right? So I want to buy this. Well, look at the maintenance risk it takes me to hold this, and to take it overnight. It's like $6,000. Okay, that's how much this margin is to hold this. Another reason why people are losing motivation to swing trade, because they look at this cost, or they'll say, man, to do one option, it's going to cost me like $5,000. And options are kind of tough sometimes because they might not have the liquidity. One, two, if they do, they have different dimensions, theta decay and things like this. Some people are frightened to play the option game because they feel it's a losing battle. This here, you're just in the outright contract. It's natural. There's no time of decay that's going to happen against you, but there's a cost. And so, if you add GHG's December, but you got to sell that one, now what you've done is, look at that. You've reduced your margin requirement. It would cost us $715 if we wanted to go, for whatever reason, go long here tonight. Again, the RR in this particular spread is not worthy. You'd be lucky if you get a 2-to-1, but I don't see a 3-to-1 potential in this minimum. And that's kind of, again, part of the investment strategy is trying to keep even more than that, because, we're keeping our risk tight on these, and I'll explain that. So I hope that you found value in that one right there. And then we'll go ahead and put this back where this belongs and shut that dome off. And so just that simple. Span margin up to 90% off. Then the outrights, you saw clearly on the platform that massive reduction in margin, obviously massive reduction in profit, but again, it benefits you in a different way. And no one's saying you only need to trade one contract, and we're also not saying just load up full span margin to your account size. You don't want to get margin called, but you can work it in a way based on your risk management, better cash on cash return like that. In one way, again, like it says here, less return for less risk. However, your cash on cash return is better. And this can help your smaller account swing trade in smaller accounts without trading that 3-dimensional options and the outright risk. And again, though, guys, all spreads are risk. They're still directional. They are a little bit more forgiving, but don't take my word for it as if that's the safe thing and just jump in. All spreads are risk because it's a directional trade. You're just a little bit less of that volatility stretch. A lot of these are very mean reverting, but you can see in the last couple of years, just like any other commodity and inflation risk, geopolitical risk, some of these spreads just got way out of whack too. So you got to still use risk management. When you're wrong, you're wrong. Okay, so there's no such thing as risk. Let me go from here, turn this back on. So pretty much that's it. Our investment strategy with this is, and the way I look at it, we're getting back into this July, got back from this trip. And so for those watching this in the future, take this as, this is a video from July 2023. Yeah, but our way of handling this is coming in 20 different markets. As of now, just for now, there could always be more. We're looking at 20 different commodities and equities, and based on our account size and how we're managing things, we're looking at basically macro levels. I'm sorry for the distraction here. Let me pull this in here so you guys can see what I'm staring at. So I have a view. I have a macro kind of chart view on everything, and in a way, that's one way to start. So I'm waiting for extremes off weekly charts and monthly charts, extremes, and these take time. And that's why we're looking at more markets. And what we're doing is we're waiting for levels and extremes, and then at the same time, then we're looking for confirmation by using some confirmation tools. Some of the confirmation tools are going to be, like I said, we're going to look at data using like our spreadcharts.com. And in spreadcharts.com, we'll be able to put these in, plug in these calendars and or different kind of spreads, depending on what's available for us. If we're willing to take the risk, if the account can expand on it and take it. And we're looking at revisiting the whole damn thing all over again, right? And then we're looking at COT, and we're also looking at seasonality. And what seasonality tells me, let's say in this case, for example, corn's been selling off. Well, it was no coincidence, right, that this is a seasonal chart and that the blue line is actually the current spread, the live market right now. Look where we are and look where corn's been going. I can probably show this on our other partner site, which shows on Season Algo, which also recommends spreads to us on a monthly basis and has historical results. Now we take that just as a piece of a puzzle and we build on it. You know, we build our macro, again, technical levels. Where am I? Where's price in the grand scheme of things? How involved are the traders? How heavy are the traders involved in this market? And are they at extremes? Our approach comes down to a more of a contrarian approach that turns into a trend style. So we want to get in on the edge a little bit early, and then we want to ride that as much as possible. So we're trying to become a contrarian while everybody is still thinking long, or short. But we're at a big extreme edge. We look at that. We look at COT data. We see that they've tied up most of their funds doing this. Not to say that it can't just keep going. That's when we use our risk management, and that's it. I mean, other than that, let me pull up that Season Algo thing, and I'll show you guys even how theirs works. And so I have multiple tools because, end of the day, some reflect. And I've been asked, by the way, I just started my Twitter channel again, and you guys are more than welcome to come and follow me. I just started it. I'm planning on putting a lot more content there, maybe. The thing is people ask why I use so many platforms, and the thing is, each one does something else to me and gives me a different piece of confirmation. If I spend several $100 every quarter, but I'm making, good returns, 4, 5, 6% a month, and 30% a year, 40 or whatever, it pays for itself. And so here's corn. This black line here is the current year spread, September, December corn, and hey, everybody says this thing gapped down really big. Let's look at our chart, and it did, right? Look at that. Look at the profiles on Taz profile too. And this was right before I went on my trails on vacation. This thing dumped, and some people had these on their alert services. But if we look at our macro levels, we were short in our minds anyway. And lo and behold, we have seasonality that backs us up, right? So we take this piece of information, and this is how we treat these portfolios. And where are we wrong? We're just wrong where we got in, and we try and keep on our larger portfolio. We're going to run on the 100K account. We're trying to keep 1%. On the smaller 10K account, I'm running 5%. And if the market isn't going to give me a $500 loser, and it's going to be more than at that entry, then we just can't take that trade at all. And for example, the thing is like with nat gas, there's never been a mentor or a firm or anybody that I know that has a sane head on their shoulders that actually trades in nat gas spreads, because of the cost is just ridiculous. It's just it could still hurt you, and it's like a schizophrenic idea to do a natural gas spread. I put it on here because I like to put it as a watch. That's why I put markets we trade and watch. There are some in a smaller account that you're not going to be able to trade because of just the cost is beyond 5% risk. 5% is already pretty risky for a 10K account. So we got to just do it. We just got to do this, carefully and manage it professionally, and over time, again, 40-45% win rate target, aiming for 3 to 1s, 4 to 1s, and sometimes 8 to 1s. The goal is that, or the target goal is that this we can afford to take 5% risk on these on the 10K account. That's just kind of one of the things, with kind of what we're dealing with. And again, if the risk is much higher, like on sometime on soybean spreads, and I'll give you guys another example here before we get off. It just might not be right for that account. Okay, so we're going to use the 100K to show, hey, we'll take 1% on these. And if the swing stop is smaller, then we just multiply contract. Real simple. That's how we're going to be doing that. Let's close that out. Let's move these guys up here, and then what I'll do is show you here, actually bar chart. So there's a couple of things we're looking at. We'll start with soybean, and I'll give you guys an idea. And I'm using the free one, so it's gonna bombard you with a lot of these little ads. Okay, but it's still worth it. Let's pop this out. Anyway, so you look at this 1 year play. We were looking at this, and it was in my head, and should have been taking this. We'll be up already like $600 in our portfolio. We'd be at 2 to 1. We have a risk up here at like $300. Target down here in these areas. Look how big that is. So we're looking at 7 to 1, 8 to 1 spreads. This is actually, by the way, today. Anybody that catches this, you may want to look for a good pullback entry into this. Something we're considering to throw in our portfolio by the end of this week. But soybean spread, this is the most upfront months, front month, back month, calendar spread. And, the risk reward potential on these is so huge, right? So if you're going to do this in a 100K account, and it's the $300 risk, then we're going to add accordingly the amount of contracts that it takes to do that. And moving on real quick here to another one I was telling the guys short on live cattle, and it's pulled back. The spread acted up on it today. I didn't like what it did. Really, I'll be honest with you, would have been a stop on our books. This spread here, and you'll see this wicked wick that came up here, probably just stopped out a bunch of other spreaders, is exactly all I can imagine it is. People could say manipulation and all that. Well, it is what it is. Okay, but here's a perfect, today, we would have been short, we would have been stopped. In a way, I'm glad. But that's the rule we would have had to take, is what's above here? Nothing. We know that we're at all-time highs on crude. On cattle. And this was probably just literally a stop run, if you ask me. Now, the outright didn't break the prior highs of last week, but the spread really got loose. So, but again, it's just what you're willing to risk to reward. So if you take the tools here and say, hey, you know what, I'm willing to risk that. You would have lost whatever it was plus slippage. Maybe right at the highs, 150 to $200. Where's our targets? Right back down at the bottom. So again, we have a 6 to 1 play, a 5 to 1 play. If you keep doing this, you're going to get stopped sometimes, but over time, you're going to have these bigger runners. And the cool thing about that is then that's when you can get away with having 40%, 45% win rate and still be above the end of the year on your portfolio. So that's what we're intending on doing here. We wanted to step up our game back and get really serious about this, and answer anyone's questions that have any, and kind of keep this video as for a refresher for those of you that have been following us and are interested in this, and future people that come and endeavor and just check out and see what we're up to, and are curious about what this kind of trading style is about. It's a great investment strategy for mid to short term. It actually could be a good income producer if you're doing it as a fund, running this money in a larger account, and you can pull it as an income stream. Okay, so that's it. Anybody have questions or anything, please let me know. I would highly recommend anybody getting involved, stay with calendars. Stay with the calendars. As you see, they can get costly anyway. and take advantage of that. I want to do span margin real quick for you guys on this cattle for you guys to see, you know, another example. Just use the span tool, span margin tool. And I guess we'll delete these. We'll add LEQ. Okay, if you were gonna just sell that one, cost you a couple of grand in margin, but if you added the back month and bought it to reduce some of that friction, I call it like a sailboat. You know, you've cut your margin in about 55%. So it's not bad. And for the risk reward too, that then you take that and you can say, hey, based on this 880 margin, you know, that you put up, which is cash you put up out of the account, if we could hit a target like we just saw, then our cash on cash return is on that particular trade is much more. Now, of course, the overall account cash return is going to be smaller. You got to be real, but I mean, just take that as an individual trade, and then put a cash on cash return value on that trade. You know, added to your overall yield for the year is going to be, you know, phenomenal. So, everybody, thanks for watching, and again, have any questions? Just visit our site and email us. All right, or comment in the videos. Thank you.